Insurance gurus are running rampant on social media, and the amount of false information that is being shared is becoming unbearable.
Social media's most followed faces of finance, 4 of them from Houston, have been arrested.
Because of this, you must stop believing in the common misconceptions and lies that are being spread about whole life insurance. The biggest misconception that I hear more than anything is the actual growth rate in tandem with the dividend rate. Because of this, I made a video that discusses the lies and misconceptions that are commonly spread about this subject. And then I will share with you how this really works. This is the last video you ever need to watch to understand the relationship between dividends and the growth rates in whole life insurance. Maybe. If you stay to the end of this video, I will also show you the real numbers on the actual growth rate on these whole life contracts and compare them to the dividend rates. So with that being said, let's boogie, shall we? All right, so as a content creator that talks about life insurance, I used to enjoy watching other content creators in this space, getting a fresh perspective, seeing the true creativity in others. But now, the unfortunate part is I'm embarrassed for the finance industry, and I officially can no longer watch the content that is being produced on social media discussing life insurance. I now just cringe inside and feel a sense of shame that we as a group are producing content that is filled with misconception. And it isn't just from a couple bad apples, it is from some of the top producers in the industry. With all that being said, let's discuss one of the biggest misconceptions in the life insurance space, the dividend and how the growth in these policies relationally really works. The misconception that gets shared is that your dividend equals your cash value growth rate. And this could not be farther from the truth. But now, what about being with a mutual carrier so you get a dividend as a policyholder, which is what makes the concept so great? Hold on to your slippers there, Cinderella. Yes, that is correct. But that is mutually exclusive from what the company's dividend scale reporting number is. And that concept is what we will be exploring. Also, real quick for the newbies, to this concept, every year based on a few factors, we will discuss this. A mutual life insurance carrier will pay you a dividend if you own a whole life policy with them. So to dive into how the cash value growth rate does not equal the company's dividend rate, let's first take a look at the 2023 dividend rates for some of the larger mutual companies. Mass Mutual, 6%. Guardian, 5.75%. New York Life, 5.8%. Northwestern Mutual, 5%. Penn Mutual, 5.75%. Lafayette Life Insurance, 5.2%. So logically speaking, if your dividend rate was your cash value growth rate, then 100% of people should write with Mass Mutual, who led the charge at 6% for the 2023 dividend rate. And you would never want to write a policy with Lafayette Life or Northwestern Mutual coming in at 5% and 5.2% dividend. The irony with that is Northwestern's claim to fame is that they pay out the largest dividend, which quite frankly is true. So let's think. They have the smallest dividend rate of the group, they paid the most. No wonder why everybody is so confused. Okay, stick with me here. Very soon, I am going to show you 4 different life insurance contracts with an insurance carrier. We are going to compare their dividend rate to the actual growth rate of these contracts to really validate the company's cash value does not align with their dividend rate. But first, how is a dividend even calculated if a dividend rate isn't the cash value growth rate? And what is looking at the dividend rate even good for? So a dividend is calculated slightly different per company, but I thought this chart here by Lafayette Life Insurance did a really good job at explaining it. Essentially, you have an average rate of a company's investment portfolio, and you factor in the cost of doing business, such as mortality cost and the expenses, and what is left over for profit is amount available for dividends. The funny part about all of this is I could have just shown this one line and ended the entire video here. It specifically says the dividend scale interest rate is not a rate of return the policy owner will earn. It's funny that they have to state this because too often this is what people think. And how do you think people learn this? They don't just make it up themselves. They hear it from good old social media. Okay, now that what I am saying is validated even without the numbers, which we will still explore, the last thing to discuss before taking a deep dive into them is what is the metric that a dividend scale is good for, if in reality it is not the rate of return of the policyholder. Well, the one metric that I think it is really good for is it shares how well a company is doing year over year compared to itself. For example, MassMutual's dividend is 6% in 2023, but in 2024, they will go up to 6.1%. This is showing a positive trajectory for MassMutual's investment portfolio and or expenses. If nothing else were to change about MassMutual except their dividend, their policyholders' cash value should increase. And in the other direction, you had a company like Ohio National, whose dividend was 5.2% in 2020 and is now 4% in 2023. This shows that the company's cash value, if nothing else changes, should decrease. So it is really good if you are a current policyholder and you want an idea on the future upside to your current policy. But what this doesn't do is say MassMutual goes from 6% to 6.1% and company B is at 5% and stays at 5%. It doesn't say that MassMutual's cash value will outperform company B. There are many factors that affect the company's overall rate of return, such as the client's age, gender, health, policy design, the product we choose, and also, yes, the company's dividend. But let's think logically about this and wrap this up with a pretty bow. Let's say you have case study A. Client is 70 years old, in not so great health, is with MassMutual and gets a whole life policy designed to optimize for death benefit with little to no cash value. And then you have case study B. Same company, MassMutual, and you have a 35-year-old healthy individual and the policy is an and asset optimized for cash value growth. Both scenarios, the dividend is the same at 6%. Because that is what MassMutual's dividend is declared. How in the world would case study A and B both also receive a 6% identical cash value growth? Let's just think logically. And this is why I shake my head when I hear you will earn a 6% on your whole life policy. Also, spoiler alert, as we look at the actual growth rate on these policies, even the most optimal design policy in today's environment will earn between 4 to 5% long-term internal rate of return. No policy over the last 20 years will be getting over 6%. So in the last decade, if you hear people say you are getting 6 to 7% growth in your policy,
but in the meantime, it's growing at 6 or 7%,
run for the hills. With that being said, let's take a deep dive into the numbers. Okay, we're going to look at 4 different policy designs. We're going to look at a regular and asset contract optimized for cash value. Then we're going to look at an all base policy, then a policy with a poor health rating, and then a policy with older age. What we're going to do is we're going to have a conversation around if the dividend is X, well, then all of the rate of return should be exactly the same. It shouldn't matter what the person has from a health conservative standpoint, a age conservative standpoint, or a dollar amount putting in standpoint, or how the policy is designed. You would think that if you're going to receive the dividend rate as a rate of return, then all of the other factors are irrelevant. And so to prove that that is not the case, what we're going to do is we're going to look at all 4 of them, compare them side by side. We're also going to do the math in regards to what the actual dividend return is. And we're also going to look at the actual internal rate of return on a policy. An internal rate of return is saying, how much cash do I have available based on the dollar amount that I put in? So with that being said, let's go ahead and take a look at the numbers. So first, we're going to start off with the and asset designed typically for optimizing cash value. That is usually the goal 99.9% of the time when we're designing our policies here at Better Wealth. And so what we're going to do is we're going to put in $50,000 a year into the contract, and we are going to see an internal rate of return of 23.8% the very first year, a negative percentage the very first year. So this policy that we're looking at, and all of them, quite frankly, are with a company named Penn Mutual. Big mutual carrier, great financials, fantastic company. We use them for a lot of our whole life contracts. So be fully transparent with that. Nothing to hide there. We write with multiple carriers. This is just one of many that we write with. And their current dividend is 5.75%. And so when somebody says across the board, because Penn Mutual has a 5.75%, they're getting a 5.75% rate of return, that is incorrect. The same thing with Mass Mutual. It would look exactly the same. They have a 6% dividend, going to be 6.1% going into 2024. Today is December in 2023, just to make this relevant for if you are watching or whenever you are. 5.7% dividend with a negative 23.8% rate of return. Internal rate of return, because they are slightly different. We'll talk about that briefly in this, but we're going to focus on internal rate of return. So it proves right away, just looking at the numbers, that your dividend rate does not equal the actual growth rate on your policy. And the reason why in whole life insurance, you cross the board, regardless of how the policy is designed, even if we're optimizing for cash value, we will have less cash value than we put in for a specific amount of years. Usually, if it's designed in a specific way, you can see anywhere from 5 to 7 years. With the current interest rate environment, dividend rate environment, just the current economic status of where we're at as a society, that is right around where you'll see policies break even. And break even is essentially saying I have more cash value than I put into the policy from a contribution standpoint. And so if we want to compare a policy that says, hey, I'm going to do an all base, which this is now what we wouldn't necessarily classify as an and asset, but this policy could be designed for someone that wants to maximize the death benefit. An estate plan, just somebody that wants to have a permanent death benefit for their entire life and doesn't care about the cash. You'll see that the first couple of years they have 0 and 0 the first 2 years, which is why it says internal rate of return not available. You also see that the death benefit is almost 4 million versus when we're comparing the optimized for cash value policy, you have 1,275,000 and you have 38,100 in the first year versus 0, and then 0 in the second year on the other policy versus this one you have 80,434. So you can see internal rate of return negative 23.8. And because there's a goose egg 0 in the first 2 years, it's NA. All right, so I have a dividend of 5.75%, but my internal rate of return is NA. Those two don't align, saying that I'm actually getting a 5.75% on my cash value. Even in year 3, if we want to compare when the real number pops up, negative 65.32% versus a and asset designed optimized for cash value, negative 7.48%. So what this is telling us is that regardless of the way that the contract is designed, regardless of all of these factors that we're talking about, your dividend is 5.75%, although the actual internal rate of returns are different. So what we're going to do real quick is now we're going to take a quick look at somebody with a poor health rating. So now we're going to just quickly glance at it. So this is $50,000 a year going into the contract, same age, but what we've done is a substandard health rating. So now you have a negative 33.13% internal rate of return versus the first one at a 23.8% internal rate of return. It's actually, you know, even when we're looking at an all base contract, which is designed for death benefit, it has a better internal rate of return, even if you have a poor health rating, just by designing it optimally, which is actually kind of ironic because life insurance is focused around death benefit. Like that is kind of the key concept. But even when it's designed properly, focused on cash, we can still make it better than doing it when it's not designed optimally for cash. Even when somebody has a very amazing health rating, this policy design here that we're looking at is designed with the super preferred health rating, as all of these, this first one is as well. And so this one here designed for death benefit, super preferred health rating. This one here designed for cash value, but poor health rating. Then if we want to look at one more, we are going to now look at somebody who's older, 65 at the end of the year, they'll be age 66. Internal rate of return 62.89%. This is also optimized for cash, but because of their age, the policy just doesn't look as great, but it still has the death benefit and still has cash value to essentially borrow against. This is still better than a 35-year-old with great health from a cash value perspective, 0, NA, even on the worst case scenarios. Negative 62, negative 41. In year 3, you have 87,000 versus year 3, we have 25,000. So it really comes down to how we're optimizing it and what's the goal. One's not necessarily better than the other, but if the goal is cash value, then obviously this one would be worst case scenario. And we would not want to design a policy like this for anybody. If that was the goal, sole goal, cash value, safe place, storage of money to be able to borrow against and use for another activity, this would not be the optimal design. This would be the optimal design, obviously, if someone is in good health. This is the optimal design if somebody doesn't have ideal health. This is the ideal design if somebody was a little bit older. And so with that being said, you can see the numbers across the board do not match up to 5.75%. And what we're going to look at is on the optimal design, great health, great age, the highest internal rate of return this contract gets is 4.84%. This is by far the best in the industry from a long-term growth performance. This is why I reiterated previously is that must talk about long-term and have that conversation. We can't have blanket statements saying that you're going to receive a 4%, a 5%, a 6%. It must be a conversation. If somebody talks about rate of return, hey, I'm going to receive a 4 to 5%, which you can then go on the high end and say, okay, well, if the high end is 4.8 and you can say 4 to 5% long-term growth, because you don't even receive 4% internal rate of return on the contract until age 18. And so this is fully transparent. Again, the end asset, overfund whole life insurance, isn't the sexy place to grow money that you're going to like build massive wealth with. This is the safe storage place to essentially hold and have liquid funds to be able to borrow against for the sexy asset producing activities such as your business, such as real estate, opportunities into the future. This replaces your opportunity funds such as your bank account. And so when we start to now want to look at the actual dividend, right? This up here says non-guaranteed, which means essentially this is the guaranteed plus the dividend. If we want to look at a policy, which is just this one here that we were looking at, which has the internal rate of return non-guaranteed. We looked at this obviously throughout this whole session. We can now look at that same policy design, but what we're going to be able to do is actually see the dividend column in here. And then what we can do is we can actually say, okay, am I actually receiving a dividend? So first we looked at what is my actual cash value growth? That was the internal rate of return. How much control of dollars do I have based off the dollar I put in? This is going to say, okay, now that I've accumulated fees, expenses from the business perspective, cost of commission to the insurance agent, all of that stuff is kind of factored in at the beginning, which is why you don't have dollar for dollar access right away. You put in 50 grand, you have 38. Even at the most well-designed, optimized policies, you still receive a dividend every year. This dividend is given to you every year at the end of the year if you receive a dividend based on the policy's performance of the insurance company. And we talked about that a little bit on the factors of how that's calculated. And so what we can do is we can say, okay, if I put in 50,000 and I receive 974, well, what is that from a percentage standpoint? So 974 divided by 50,000, boom, 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 5,000, 50 equals, that's what, 2%? Maybe that's essentially what it is at the best at the end of the day. This would be 10, yep, 2%. So that right there is not. Now we put in 100 grand, you have 2,073. That's essentially 2%. Like we can kind of just keep going, right? 2,000 of 100 is another 2%. And so what I always like to tell people when people ask like, well, what is the growth rate? And you kind of try to split up, like how do you talk about it? Well, the guaranteed side is going to be anywhere around 1.5 to 2.5% long-term growth of an internal rate of return. And the dividend is going to be 1.5 to 2%, 2.5 long-term internal rate of return growth. But all of the factors vary based off of age, gender, how we design the policy, health ratings, and every company, they have different products that you can choose. So even with Penn Mutual and Mass Mutual, especially Mass Mutual, they have like 5 different whole life policies that you can choose within whole life. They got a Heck V, a whole life 99, a whole life 100, whole life 65, a 10 pay. And so because of those, that creates a cost difference in every single contract, which essentially gives you even more reason to say, okay, I get it. I understand that the dividend rate that is classified by the insurance company that they announce every single year is not the actual internal growth rate on the policy. It's not even the dividend growth rate on your policy as well. It's because we have those things we talked about, the expenses, mortality costs, cost of doing business. There's so many factors that get put into this to the end result of what you're receiving as a policyholder, which is truly what is important. So I hope this helps. I hope this clears it up, wraps it up with a pretty bow on why we do not want to say whatever the dividend rate is, that is the internal growth rate or growth rate on our whole life insurance contract. Thanks for taking time out of your day to watch this video. Please click the subscribe button. And if you want to work with someone to optimally design a whole life contract for you, we are your company. Click the link below in the description. We are more than happy to help. Talk to you soon.